Hello there, I am your host Alex, and welcome to The Explainer. Now let me ask you a question. Have you ever wondered if it's actually possible to double your money in a single year with an investment fund? I know, it sounds a little too good to be true, but today we're going to look at some funds that did exactly that, and we're going to uncover the crucial trade-offs they had to make to get there.
So, is it really possible? Well, today we're breaking down some investment funds that have posted some truly mind-blowing results. We're talking about returns that seem almost impossible, the kind that can literally double your money, maybe even more, in just 12 short months. Just look at this number, 140%, in a single year. Yeah, that's a real number from one of the funds we'll be looking at today. That's right, 140%. But, a number like this never tells the whole story. To really understand how it's possible, and more importantly, what the risks are, we need a clear plan. So here's our roadmap for today. We're going to start by setting a baseline, then we'll dive into dividend funds, check out precious metals, and shine a light on some super niche sectors. Then we'll wrap it all up with the big dilemma every single investor faces. Okay, first things first. Before we get into all the high flyers and the crazy returns, we need a solid point of comparison. We need a standard, a broadly diversified fund that can act as our baseline. Context is everything. And this is the perfect example, the Vanguard All-World ETF. Look, it delivers solid, steady returns, the fees are low, it's a great fund. But the most important number on this slide for our analysis today, it's right there on the bottom row. This fund holds shares in over 3,500 companies. 3,629. I want you to burn that number into your brain. It represents massive global diversification. It's all about spreading your risk. This is our anchor point, and honestly, it's the key to understanding everything else we're about to talk about. So with that baseline firmly in place, let's move on to our first category, funds that are specifically designed to generate income through dividends. Now, these funds have had a really strong year. Just take a look at this iShares fund. It returned an incredible 48%, and it pays out a pretty healthy dividend. That's a fantastic result, right? So, what's the catch? Well, here it is. A 48% return is awesome, but look at the number of holdings. This is the trade-off in action. To chase that much higher return, the investment is concentrated, going from over 3,600 stocks all the way down to just 30. And this isn't just a one-off thing. We see the exact same pattern with other high-performing dividend funds. The VanEck fund holds 100 companies. The iShares UK fund holds just 50. You see the theme here, right? Higher potential returns are coming from much higher concentration. Okay, now for a category that has had, a truly phenomenal year. Precious metals. They're often seen as a safe place to put your money when things get uncertain, and boy, did their value soar. But first, it is really important to understand that there are two different ways to invest here. An ETF in this space usually owns shares in the companies that are related to the metal. Think gold mining corporations. An ETC, on the other hand, an exchange-traded commodity, is different. It's designed to track the price of the physical stuff itself, like literally the gold bars sitting in a vault. Okay, so with that difference in mind, take a look at this ETF. By investing in gold mining companies, it delivered that insane 140% one-year return we saw right at the start. And yep, you guessed it. Here's why. That incredible performance comes from being highly concentrated in just 65 mining stocks. When you compare that to our benchmark of over 3,600, you can see it's a very, very focused bet on one single industry. Now, what about the ETCs, the ones that track the physical metals directly? Well, the returns there have been just as stunning. Silver and platinum both delivered over 100%. Gold posted a very strong 57%, and all of them did it with relatively low fees. This brings us to our final category, and these are the real specialists, highly focused niche ETFs that go all in on one specific industry. I mean, look at these. From space exploration to battery technology to semiconductors, these funds let you put your money on a very specific trend. And with so much excitement around innovation, the returns have been huge. 87% for the space fund, 63% for batteries. But, and you knew about what's coming, this hyperfocus comes with the biggest catch of all.
The number of holdings is tiny. We're talking just 25 companies for the space and semiconductor funds. You are basically giving up that safety net of diversification for a high-wire act, betting big on a very small handful of companies to succeed. So, after seeing all these incredible returns, from dividends to gold to space tech, what's the single most important thing you need to remember from all of this? It's this phrase right here. And I know you see it everywhere. It feels like a standard legal disclaimer, but it is not. It is the core lesson of our entire analysis. Just because a fund had a great year last year gives you absolutely zero guarantee it will perform well next year. In fact, a lot of the time, a sector that has boomed is the one that's most due for a fall. So the bottom line is this. These high-return funds are always a trade-off. You are sacrificing the safety and stability of diversification for a shot at higher gains. A smart way a lot of people approach this is to build their portfolio on a stable, diversified foundation, like that all-world fund, and then maybe add these more concentrated funds as smaller satellite bets, not as a replacement for the core. And all of this really brings us to the final and most personal question you have to ask yourself. As an investor, what's more important to you? Is it chasing that highest possible reward, even if it means taking on a whole lot of risk? Or is your main goal to manage that risk, and you're okay with more modest gains in return for more stability? There's no single right answer, but knowing your own is absolutely critical. What's your opinion on this? Share it with us in the comments section. Thank you for watching WealthPrint.